In July and early August of 2015, I bought Apple for $32 per share adjusted for the 4-to-1 split. I bought EA for $71 and Netflix for $124 per share. Today, those 8 Apple shares would be worth $4,576. My 13 EA shares would be worth $1,898, and my 3 Netflix shares would be worth $1,671 at the time of this recording. That means my total investment of $2,385, which is all I could afford at the time because I was a broke university student, would have turned into $8,145. That's a 241% return on my money, which means that it multiplied almost 3.5 times over. Over a period of 5.5 years, that works out to an annualized average return of about 25%. Compare that to the S&P 500, which earned about 13% over the same time period. Crazy. But unfortunately for me, that gain never happened. Let me tell you the sad story of why. Back in 2011, the stock market was sitting around 1,270 as per the S&P 500. Over the next 3 years, the market enjoyed a nice, steady, and very smooth climb all the way up to 2,100 in August of 2015. That's when I entered the scene. Now, at this point in my life, as I said, I was a student at university, so I didn't have very much cash, but with some of the very small amount of cash I had, I was using to kind of dip my toes into the stock market. So I was trying out stock trading as well as a little bit of options trading, and I was having a good time learning a lot and doing pretty okay at it. But as I began to learn more, I knew that I wanted to transition into some actual long-term investing. So I started positions in Apple, EA, and Netflix. Now, I'm trying to think back to remember why I chose those companies specifically, but I can't really remember why. I think I must have just thought that I had faith in these companies continuing to grow into large and powerful and prosperous tech companies, which they did end up doing. But here's where the big problem came into play. At that very young and tender age, I didn't really have a good grasp on long time horizons in the stock markets, years and years and years. I was thinking more like months and maybe like a year out. I didn't have that really good grasp on very long periods of time. So on Monday, August 24th, just literal days after I had bought all my stocks, the market experienced what is known as a flash crash. Within literal minutes of the market opening, the S&P 500 fell from 1,965 to 1,867, which was about a 5% drop in minutes. Now, I had been trading kind of small penny stocks a little bit and options and things like that. So I was used to some pretty big swings in the stocks that I was holding. So I thought to myself, okay, this is a bit strange, but no problem. We've seen this before. We're going to be okay. It should end up bouncing back. But then I started reading the news, and I was reading headlines that were saying that the stock market was extremely overvalued and we were about to have a massive crash. Huh? Overvalued? What the heck were these guys talking about? I zoomed out on the chart of the S&P 500 and saw exactly what they were talking about. For years, the stock market had been just going straight up. After the Great Recession in 2008, the central bank started quantitative easing and printing money, which supposedly helped inflate the stock market. But now it was time for it to all come crashing and crumbling down. The more I read, the more I was sure and afraid that this wasn't just the stock market crashing. It sounded like the entire economic system was about to collapse. So, as the young, naive investor I was, I did what anybody would do. I held those with diamond hands and secured those big fat gains, baby. No, that's not true. I panicked. I panicked like a little paper-handed, and I sold. And then what did the stock market go on to do? It proceeded to have another little hiccup in 2016, but then go on an absolute tear all the way to today, where it miraculously just trucked right through a global pandemic. You guys ever play Madden back in the day on PS2 or Xbox? Do you remember the truck stick that you could use to like hit through people when you were running with the ball? That's what the stock market has done to literally every single problem since 2008. OPEC messing with the price of oil? Massive debt loads? A literal global pandemic? I thought it would be fun and helpful to start with this story to get into this video because we are once again at a moment in time when many people, it seems like there's actually a general consensus that the stock market seems to be pretty overvalued. And I'm one of those people who was kind of also saying that. But just because all the valuation metrics of history are pointing to an overvalued stock market, I really don't want you to make the same mistake that I did those years ago. The first truth that I learned about investing in the stock market the hard way is that no one knows with 100% certainty what is going to happen. The stock market may go up, it may go down, it may also just trend sideways. Nobody knows for sure. The second truth I learned is that there will always be bears, especially perma bears. Now, these are the people who are basically always negative on the stock market. They're always calling for a crash, and a lot of them call for massive crashes that will basically end the world. They spend decades saying that the next massive market crash is just around the corner and this one will be worse than all the ones before. It's equivalent of being in the middle of summer and then going up to somebody and saying, hey, you know, one day the sun is going to stop shining as much and the water will turn to ice and your bones will quake with cold. Of course it will be true if you keep saying it for long enough, but how much time and money have you wasted for a day that may be tomorrow or 10 years from now? So the key to investing, especially in times like this, is to find a way that allows you to participate in the stock market while also being able to handle market crashes. You see, if you exit the stock market, well, now you're exposing yourself to the opportunity cost of future gains that you might miss out on. That's a risk. But if you stay in the stock market, well, then you're exposing yourself to the risk of the stock market crashing. It's all about finding the balance between these two risks. We don't want to try and dance in and out of the stock market because it's incredibly difficult to do that consistently for a long period of time. I mean, you would just need a crystal ball pretty much to be able to do it. Just look what I did when I sold my stocks because I thought we were going to have a massive crash. I missed out on huge gains. I don't want you to make that same mistake. So now let me talk about how I'm planning on investing my money going forwards. Now, first of all, my portfolio is kind of going through a restructuring phase right now because I quit my former kind of corporate, safe, normal job and now I've transitioned into working for myself. So as I made that transition, I also had to kind of restructure my portfolio accordingly. So because of that, I'm pretty cash heavy right now. I have about 50% of my portfolio as cash to be exact. Now, that's a lot of cash. That's very cash heavy. That's a huge opportunity cost. I don't want to have that much cash sitting out of the stock market for very long. So I'd like to definitely get it into the markets. Now, I have a target portfolio in mind that I'd like to achieve by the end of the year, and that's what I'd like to share with you right now. So here's how I'm conceptualizing portfolio construction, wealth building, wealth preservation right now. I imagine it like a kingdom. In the innermost depths of the kingdom is the treasury. This is the most well-protected and safe area of the keep. So naturally, this is where your safest store of value assets would be held. This would include cash, gold, and potentially Bitcoin in the future if it continues to prove itself as a store of value. By the end of the year, I'd like to have about 5 to 10% cash here. There is definitely an opportunity cost with keeping some cash aside like that, but personally, I'm okay with it. Psychologically, it just works better for me. And hey, that may be different for you, that may be different for all kinds of different people, but I think what's important is that we do what works for us. Next, we have the royal keep. This is where the royal members of the kingdom reside, so it is also quite safe. Almost as safe as the treasury. This is where bonds and treasury bills would live. But at this time in my life, I don't have any plans to buy bonds right now, so this will be empty for the time being. Third, we have the barracks. This is where the main army will be. They will be responsible for heading out into battle and then collecting riches for the kingdom. As they will be in battle, my army is exposed to risk of loss. But I'd like to structure my army so that its forces are well diversified. I'll have soldiers on foot, on horseback, as well as archers, for example. This force represents my stocks, so I plan on having a globally diversified mix of Canadian, American, and international stocks. By the end of the year, I'd like to have about 67 to 72% of my money here in low-cost passive index ETFs. So these three categories make up the main kind of fortress of my kingdom. But I'm not done there, and that's because I also have kind of thought of these three special forces that I want to assign onto specific tasks for them to accomplish. My first special force I will assign to set out from the kingdom and explore the world of cryptocurrency. They will acquire Bitcoin and other cryptocurrency of interest and then return it to the kingdom. By the end of the year, I would like this to be about 10% of my portfolio. And if Bitcoin continues to prove itself as a store of value over time, it will conceptually move to live in the treasury portion of my kingdom. The second special force I will assign to become specialized soldiers in the army. Maybe magic exists in this imaginary world and they become wizards, for example. That would be really fun. These wizards will represent individual stocks that I choose to add to my portfolio. Now, most likely, I will already own these stocks in those ETFs that I hold in my main army. But the point here is that I will buy kind of more of these specific individual stocks, and that will essentially overweight them in my portfolio because I have a stronger conviction on them. Which is kind of funny to think about it like a wizard, because I'm taking a normal foot soldier who's already in my army, just like I'm taking a stock I already own in the ETF, and then I'm beefing up that soldier to a wizard. Or in other words, making that stock a bigger position in my portfolio. So it's kind of a fun way to think about that. I'm aiming to choose about 3 to 5 companies or 3 to 5 lucky soldiers for this and use about 10% of my portfolio to do it. For the third and final special force, it will be a band of merchants who use their skills of trade to create a hedge against risks that the kingdom faces. In my portfolio, this represents tail risk hedging. Now, tail risk hedging essentially just means hedging against very big drops in the stock market. Now, if I'm tail risk hedging and a big drop occurs, then these hedges are going to earn a very large amount of profits that I can then take and then use it to buy more of the lower price stocks because of that crash. But the thing about tail risk hedging is that if the stock market is moving sideways or going up, these hedges are going to either lose a little bit of money or they're going to just about break even. So it's very important that this is done correctly so as to not cost you too much of your portfolio to do this. And this is something I'm still learning more about how to do that the best way, but I'm probably thinking of doing something like options back spreads to do it. And I'll use about, I think, 3% of my portfolio. So I think this is a fun and kind of really interesting way to think about conceptualizing and visualizing portfolio construction and wealth building and wealth preservation, because it allows you to see how each individual part works, but then also how it all comes together in the end. And the cool thing is you can take this kingdom idea and apply it to your own portfolio. I mean, have fun with it. Personal finance, I believe, is called personal finance for a reason, and that's because it's personal. There's no one-size-fits-all approach. We all have different circumstances, backgrounds, and goals that we want to achieve in our lives. And my kingdom is also probably going to change a lot over time, you know, especially as I grow older and kind of move through life. One of the things I'll probably do is shift a lot of my resources kind of inwards into the safer parts of the keep, into the royal keep and the treasury, to keep more of my assets safe. But by having these set targets for my portfolio and structuring it in this way, I can confidently invest no matter what environment the markets are in, whether it is truly overvalued or it's not. That's because as these various assets move around, I can use a technique called rebalancing to essentially make sure everything stays in its target proportions. For example, if stocks go down but crypto goes up, well, hey, I can sell some of my crypto and then use it to buy some of my stocks to bring everything kind of back in line. And what I've done there is by rebalancing, I've essentially sold something when it's high and bought something when it's low. This is what we want to do as investors. Now, I could go on and on and on and on about this kingdom conceptual idea because I think it's really interesting and fun to talk about, but I think this video is already pretty long at this point, so I may have glossed over some of the points of this idea that you might have questions about or you're more curious about or anything like that, but just let me know in the comments down below if you want more content on this kingdom idea because I would be happy to make it. I hope you found this video helpful, and if you did, consider sharing it with somebody else who might find it interesting. If you enjoyed the video, please give it a thumbs up, subscribe if you're not already, and thank you so much for watching. I will see you again soon.